Okay, I've got 1 minute after the hour, so I think we'll get underway now. Welcome this afternoon to the webcast put on by Impact, COVID-19 Tax Impact, How to Survive It and Conquer. I'm Kevin Hilton, I'm the CEO of Impact, and as many of you already know, the goalposts keep moving. And our job here at Impact is to keep you prepared as possible to address the COVID-19 related business concerns, either as a business leader or a labor leader. So this is the fourth in a series of webcasts that we've put on to arm you with the information you need to survive and prepare yourself to succeed as we come out of the pandemic and attempt to return to whatever the new normal will be. Now keep in mind that all of these previous webcasts and this one today have been recorded, or today it will be recorded and stored on our website right on the front page. So all you have to do is go to our website, www.impact-net.org, and right below the fold, there's a listing of all of our webcasts. They're all recorded in YouTube. You click on it, and you learn what you need to learn. So if you need to go back and re-listen to this or other either Canadian or US content, it's very easy to do so. If for some reason you wish to ask a question that's not in the Q&A of this event, you'd prefer to ask it offline, all you have to do is email us at CAREACT. So CAREACT at impact-net.org. Once we get that, we'll review the question you're asking, and we'll make sure we forward it on to the appropriate subject matter expert, either Bob Cohn, who we have today, Matt and Pat, who we've had a number of times, Lindsay Maskell out of Toronto covering Canada, or Carrie Walters, the head of our build program, or whatever subject matter expert we need to get you in touch with, we will. Again, our primary mission in putting these things on is to make sure that you have good, secure knowledge and you're prepared to come out of this thing at a steep incline. Of course, in addition to contacting me, my contact is on our website. Feel free to contact your Impact Regional Director. We have Mark Thomas in the Northeast. Kenny Waugh covers the Southeast. Zach Gorman covers the Midwest and Heartland. Harvey Swift in the Southwest. Jimmy McGuire in the West. And Bert Royer has a very small territory. It's called the Country of Canada, from sea to shining sea. Any of those guys are willing and ready to take your calls at a moment's notice. Now, on the screen, many of you have been on with us before, but for those who haven't, look at the bottom of the screen. There's a button that says Q&A. If during the course of this webcast you wish to ask myself or Bob a question, or just throw out a general question about the subject matter, type it in. We will be monitoring the Q&A box below. I'll be doing that myself while Bob's giving the presentation, and we'll budget plenty of time to answer as many of those questions as we possibly can. Please try and stay away from the chat button, because we typically don't monitor that during this webcast. So with that, today we have Bob Cohn here to discuss the tax implications of the various federal stimulus programs. And just by means of a short bio, Bob is a CPA and a managing member of Tributum, based here in the Washington, D.C. metropolitan area. He holds a Bachelor of Arts in Business Administration and a Master's in Business Administration from the University of Maryland. Fear the turtle. Bob, I turn it over to you. Thank you very much for appearing today.
Kevin, thank you very much for the opportunity to talk to you as well as the rest of your members. This is a crazy time, but I will have to let you know that while it may be a little crazy time right now, truly believe that because of some of the things that the government has done, as well as some of the tax provisions that they have instituted to get us through this time, I think the future will be fine and great for everybody. A little bit about me is as a CPA, I focus on the tax world, but more so, I kind of help people build wealth. I'm also a certified financial planner, so I kind of take a very different view as far as the tax world is concerned. Yes, I know all about the IRS code, but really it's about how you can build wealth utilizing the tax code to grow your wealth and to build your business. And I also get involved in a lot of mergers and acquisition situations as well. So I'm there to help you grow your business overall. So just a little bit about me. Let's talk about the tax code and what the government has been doing, and just a little bit of history. And history is only a little bit more than a month old when we started to have the real impact of COVID-19 on our economy. There's some dates. Just March 13th, 2020, Trump issued an emergency determination, meaning that it allowed the IRS to do some things, to allow them to loosen up the tax code and encourage the states to consider to get some federal assistance. It was really before we saw with all the economic disaster that was occurring. So it was really just a month and 10 days ago. So it's incredible what has happened in such a short period of time. A week later, a major disaster was declared for New York State, and then 2 days later, Washington and California were declared as disaster areas for the government. Now let's look back a little bit, and it was just January 31st, 2020, is when the Chinese travel restriction was instituted by Trump. Now, realize what happened after that is, or since January, about 400,000 people came from China without any screening procedures. Brought over the COVID-19, and all those 400,000 people came into mostly airports in major locations: Los Angeles, San Francisco, New York, Chicago, Detroit, Seattle, and Newark. All really the hot spots where the COVID-19 has really hit the hardest. So it's kind of pretty predictable of what we've seen so far as this disease is concerned. And the government is trying to react in such a way. So when the disaster was declared, the IRS code went into effect, and the regulations authorized the IRS to postpone either tax-related deadlines. They can go up to 1 year. But what they chose to do is they postponed the tax filing originally. Naturally, it was originally scheduled for April 15th. Give us all another 3 months to either procrastinate more or get everything in line and get some tax returns filed, especially if you can get a refund. This is the opportunity. If you're really in a refund situation personally, and you should know that, get those returns filed. But these postponed, you're filing your income tax return, your excise tax returns as necessary, employment tax returns got postponed, and especially this postponement is not just filing your tax return, but also paying your income taxes until July 15th. Now that July 15th deadline is just for paying your taxes and filing the return. If you need an extension to file the return more, you can extend it up till October 15th, but it doesn't stop you. It means that you have to pay whatever you're going to owe by July 15th. Also, that means that all penalties and interest will not start accruing until July 16th. Also note that that July 15th date is going to be a big cash crunch day, because not only is your 2019 balance due on your federal returns, and probably most of the states as well, most of the states have postponed until July 15th as well, but also is your 2020 first and second quarter estimates for your federal return are also now due July 15th. So we'll see what happens. And this is the target keeps moving for sure. Maybe the IRS will come back and say, you know what, we may give you an additional extension, depending on what happens with COVID-19. But I would expect it not to change, that everything is going to be July 15th. So let's get your dollars and cents set up so that the money is there on July 15th. What's the Fed has gone so far? What their goals were when they started to implement the PPP loans as one thing, and helping as far as some of the tax changes that they put into effect. What's been the goal of the legislation? And I think very important that we kind of lose track of. Yes, it was good that we needed to get cash into people's hands, but we also want to ease taxpayer stress. There's been so much happening due to COVID-19, both mentally as well as physically, to basically everyone in the world. One thing that the IRS could do for the first time ever is try to leave some of the taxpayer stress by extending the filing period to July 15th. The government's goal, though, was to keep people employed as much as possible, so they really didn't have to reach too much into their pocket to pay for unemployment. Yes, they reached into their pocket and put $2 trillion back into the system through the PPP loan and their other programs, and we'll talk about that in a second. But their goal was to keep people employed, and that's what the tax code and the tax legislation really helped to do. We'll get into some of the details of how that really worked and whether it's going to work. Only time will tell. They want to increase the liquidity of business and reduce the cost of capital so that businesses can continue operations as normal or as close to normal as possible and keep their people employed. How they did that, again, with the PPP loan as well as the economic injury disaster loan, the EIDL, which is directly through the SBA. But overall, we wanted to get cash into people's hands, either for individuals, for normal employees, or they wanted to get the stimulus check in their hands. If people that lost their jobs or were furloughed, they want to get some cash in their hands through unemployment and the enhancement of an extra $500 per pay period or per month, or actually it was $600 into their unemployment checks. They enacted some tax incentives, which we're going to talk about today, and also the loan incentives, the PPP loan, the EIDL. All the states in each county also have some loan incentives or grant programs, even better, because grants are free money. Each state, each county even, has instituted some type of plan to get money into their constituents' hands. But mostly all these ideas was to buy time. The PPP loan especially was instituted to buy time for the government so that people have cash in their hands for at least 8 weeks. 8 weeks are going to be up sooner than you think. That's why we're pushing so hard to get business back up to speed and back open, especially the government's point of view. especially the federal government, and Trump being one, trying to push to get businesses open because they know that if they don't get them open within 8 weeks, we're going to have to go back into Congress and ask for more money. And that's what really the discussion is going on right now is, okay, we got the first legislation that went through that helped people that were directly affected by COVID-19. Then we had the second one, the CARES Act, that put $2 trillion into the system and instituted the PPP loan. Now we have the third one going into effect that's going to probably be signed today to get more money into the PPP loan and get more money back into the small business. But is that going to be enough? There's already talking about having a new bill. So we'll see what's going on. Things are moving very, very quickly. And if you're confused out there, you're not the only one. There's just a lot of legislation, a lot of changes that are going on. And my firm is trying to be the calm in the storm. And if you have questions about anything related to the economy as it is right now, not just the tax code, feel free to ask a question and we'll try and help you through. But we're throwing a lot of money. The government is taking on a lot of debt. And what's the future cost of that? I don't think they really care about it right now. We're just trying to get through and survive. But the tax code is going to give you opportunities to really thrive and really conquer this thing. And I'm going to try and focus on that as we get to our next slide, which we're going to talk about and where the money is. So I'm going to show you how some of the money can get into your business through a number of different tax legislation that has gone through in the past few weeks. And it's really been just a few weeks. It's just incredible. So we're going to talk about these items. Most of them are related to payroll. Most of them are related to keeping your employees on staff or to keep your businesses going. And if there are losses, there's going to be real opportunities to get some back money and get more cash back into either your business or in your personal hands. So we're going to talk about all these different items over the course of the next 30 minutes. So what has happened so far as the Relief Acts are concerned? First of all, there was the Family First Coronavirus Response Act, the FFCRA, only enacted a little bit more than a month ago, March 18th, 2020. And it was really directly helping people that were directly affected by the pandemic, by COVID-19, whether it be family members or individuals themselves. And it expanded the Family and Medical Leave Acts mostly for employees. Employers were able to get some tax credits. We're going to talk about the specifics in a second. And it helped some of the employer-sponsored health plans, gave some in a general way. But then that wasn't enough. So basically almost 10 days later, or actually 9 days later, the CARES Act went into effect. So these things just keep moving as the needle keeps moving on this COVID-19. The government has been very quick to act. So just a little bit less than a month ago, the CARES Act went into effect. $2.2 trillion, the largest economic stimulus in history. Mostly to get cash in individuals' hands, small businesses' hands, and enhanced the unemployment. I'm not really going to get too much into unemployment at all. We're not going to really talk about the PPP loans or the EIDL loans directly, but we're going to talk about how it how it's impacted as far as tax is concerned. And there are also additional tax cuts, all things we're going to talk about. So just to give you a little bit of history, this is where we are. Again, today, the CARES Act 2, we'll call it, again to fund small business, is going to add another $1 trillion or so. So what's happened specifically? The first thing that the government tried to do is to, again, the idea is to keep people employed. But what happened first, COVID-19 was directly affecting employees that were coming down with the disease. So the government wanted to help these employees first. And they instituted a refundable credit for FICA tax for employees who were taking paid sick leaves or family leave. And this credit at that point in time was fairly limited. It only offered a credit on your FICA tax of equal to 100% of your sick leave wages for up to $510 a day for a maximum amount of $51.10 total. And this is for employees that were unable to work due to local quarantine, self-quarantine, or experiencing coronavirus symptoms. Just for those, and so it became very, very limited for those particular employees. They expanded it a little bit to family members as well. And they expanded the time frame. So again, these are refundable credits against your FICA tax. That's that 6.2% on payroll tax, not the Medicare tax, which is 1.45%. It's that 6.2% payroll tax called FICA or Social Security. You're going to get a credit as the employer if you have employees that needed to take leave as for sick leave or for family leave. The family leave portion, which is specifically called the child care leave credit, again is 100% against 100% of your family leave wages up to just $200 a day for a maximum of $10,000. So it's going to be for up to 10 weeks of leave. So it's pretty significant as far as the time frame is concerned, and it's going to provide you up to $10,000 of credits against your FICA taxes. The tax credit is applied against, as I said, against your 941 taxes. When you file them quarterly, you'll be able to take that credit. And just so you know, the tax credit is dollar for dollar against any tax dollars that you have to pay in. So it's not a deduction, it's a credit. So that is dollars in your pocket. They have a similar rule also for self-employed employees, self-employed individuals. We're not going to talk about that too much. I don't think there's any self-employed individuals out there, Kevin. Mostly are, so we're not going to talk about that too much. And also, what's kind of nice as well is that sick or that family leave wage that you pay is also excluded from FICA tax. So what that means is these credits are not taken against the people that are really sick or had to utilize the sick or family leave. It's going to really be the credit against the wages and payroll taxes that are paid for your other employees. So it's a real benefit if someone has the disease to be able to take some of these credits.
Bob, I don't want to jump your presentation, but I'm sure a number of people are wondering. I've been asked this question many times. a lot of our businesses, small family businesses, and, the experience here is you keep paying your employee. We Impact have advised through our experts, all of our employers that are listening and will take our advice to apply for EIDL, PPP, state, county, whatever.
No
But
doubt.
you gotta have money to be able to make this payroll, right? What do you do if you're so close to the road on this thing that you can't make payroll?
You defer the payment. Okay. First of all, on the payroll taxes, let's talk about this real quick. Okay, there's one side of things. The government recognizes that if you can't make payroll, for sure, we're going to help you as much as you can. That's why they instituted the PPP loan, so you can get some money into your pockets so that you can pay your employees. That's why it's so important to apply for that PPP loan. That's why it's also so important to apply for the EIDL. But they're also said, okay, if you're really doing that and you're really paying your employees, we're also going to let you defer that payroll tax payment, that 6.2% on the employer's portion of the FICA. And that deferral is significant. It's for 9 months. So all your employer portion of your FICA that you're incurring, you can defer that payment for 9 months. Now, you do have to pay it. You do have 2 years to pay it. So what they've said is the deferral will go into place for 2020, and then you only have to pay half of it in 2021 and half of it in 2022. No interest. No, there is interest. I'm sorry. There is interest on that money, but I believe the guidance really hasn't come out yet on it. All they've said is they're not going to be charged a penalty. Normally speaking, the interest paid on IRS debt is not so bad. It's about 4.5% right now. So it's not so bad. And if you need to defer, this is one way around that. But you're not eligible on taxes incurred after the loan forgiveness, meaning that if you get your PPP loan and you get that loan forgiven because you used it for payroll, the government is also saying, we're not going to allow you to defer also. You either get one or the other.
But what if you're in a situation where it's not unusual in the construction industry to wait 90 days or longer for your money? I mean, what if you just don't have the bank to pay your employees? And can't get blood out of turnip, or how does that shake out?
That's a business decision mostly. I still say getting the PPP loan is really great. If you can't pay your employees and you've decided to either furlough them, and you want, but still getting that PPP money, that PPP money is still great. It's still a 1% loan. You still have 2 years to pay it back. We don't know. It's going to be a moving target, Kevin.
And part of it will likely be forgiven.
It's a business decision that has to be made.
Yeah. Okay.
Okay.
Yeah.
No easy answers here, and that's why it's important to get some good advice, either from your organization or feel free to call us.
And we've said
everybody's situation is different.
We've said in the previous iterations of this, be it in Canada, the U.S., guidance and rules have literally changed hour to hour. So this is a moving target. Like I said at the beginning, the goalposts are moving all the time.
No doubt. We're going to talk about the employee retention credit. The important thing to know here is, first of all, if you're getting PPP money or the EIDL money, you're not going to be able to take advantage of this employee retention credit. This employee retention credit was set up on that, when I was talking about the first part of the Coronavirus Tax Relief Acts, the one that was really going to affect people before the PPP loan. This is what was put into effect. This was the idea that, okay, eligible employers, if you were affected by COVID-19, either you had to be shut down or your gross receipts declined by more than 50%, you can take advantage of this employee retention credit, which again, same idea, is a refundable credit against paying your FICA for up to 50% of the wages paid to your employees during the crisis. So a much better, much larger amount, and this is just for employers that were affected by the COVID-19, which is pretty broad. But there's a measurement there again, is that you have to have your gross receipts decline by more than 50%. Again, related to people that are directly affected by COVID-19. And again, what happened, and again, this happened as the first part of the tax stimuluses, the second part being the PPP loan. And what the government realized was that everybody would be affected one way or another by COVID-19. And they offered the PPP and the EIDL to almost everybody. So while this employee retention credit was really important when the first act was put into place, when the CARES Act went into effect, this particular credit didn't have as much pull and weight after the PPP loans. Oops, wrong way. There's qualified wages there. So if you're a smaller business with less than 100 full-time employees, all your wages qualified for this employee retention credit. Less so if you have employees of more than 100 employees. So it's because of the PPP loan, I believe that this credit is not as important, because most small businesses are getting the PPP loan. However, if you have more than 500 employees, which is what a small business is considered for the PPP loan, this employee retention credit may help you. And also in anticipation of receiving some of the payroll tax credits, penalties can be waived. That gets involved with how your 941s, which is where you report your FICA taxes, how that's being filled out. I just want you guys to be aware of that form needs to be filled out properly by your payroll tax people. So now we get into the real opportunity for really conquering and really taking advantage of the tax code is on net operating losses. Net operating loss naturally is, we're trying for net income, but sometimes we have losses. And 2020 is one of those years where we may operate at a loss. And sometimes, if you have good accountants, sometimes you can generate operating losses. So this is really important for you to get in touch with your tax accountants and your CPAs to talk about this particular part of the code. And what the CARES Act did was it modified the tax act that Trump initiated 2 years ago. which said, we can only carry forward net operating losses. Well, the CARES Act modified that and said, you know what, we can start carrying back those NOLs. And what they said was we can carry back the losses for 2018, 2019, and as well as 2020. So they retroactively said, you know what, you have losses in 2018. We originally said you can carry them forward only, but now we're going to change that and we say you can carry them back. You can carry them back for 18 and 19. And also what they said was instead of carrying back 2 years, which was the old rule, now you can carry them back 5 years. 5 years. Significant change. That means you can look at your tax years for if you have a loss in 2018 that you happen to generate, and you were carrying those losses forward, now you can amend your returns and go back to 2013 and 2014 and 2015, as well as 16 and 17. And why that's significant is because those tax years we had higher tax rates overall. The rates went down for 2018 and 2019 tax years because of the TCJA, which again we'll call that the Trump Tax Act. Well, now you could take the income and losses that you might have generated in those post TCJA years and carry them back to tax years where your tax rates were much higher and get money in your pocket from getting tax refunds by carrying back those losses. This is really significant. This is something you should really be talking to your tax accountants about to see if you can carry them back. They also modified the tax carry forward rules. You're allowed to carry back, you can allow to carry forward 100% of losses in 2020, for 2021. The deduction is limited to 80% after 2017. So they really just slightly changed that law. 18 and 19, it was supposed to be 80%. Now they've carried it forward to 21 starting, that you can start deducting 100%. Again, it's a slight modification, just need to know about it, but the important rule here is the carryback. So my idea for everyone to look at is start reviewing your 2015 and 2017 tax returns and 2016 tax returns, and see also if you can generate a loss for 2020. Chances are there's probably some opportunities that your accountant can generate a loss by paying excess salaries or paying some expenses that you may be able to have some excess cash because you're taking on some more debt. Maybe making some extra payments, depending on whether you're a cash basis or a pool basis taxpayer. There are ways that you can generate a loss and look back and see if there's possible taxable income that you can offset these net operating losses with from prior years. A significant opportunity here to do a little bit of tax planning and get real dollars back into your pockets. A little confusing, but a great opportunity to talk about with your accountants.
But Bob, and that's interesting. Obviously, as the Supreme Court said many, many years ago, it's every American's obligation to pay as few taxes as possible. So, I mean, there's nothing underhanded about this, but
right.
I'm at a loss, what's the gravity of this? So, I mean, could you really have extreme positive effects on your business as a result of this, or is it moderate at best?
You bet. It depends on what your situation was. Everybody's situation is a little different. If you were paying if those years, though, that 15, 16, 17 tax years were really big years for you, and now because of COVID-19, you're having a down year. Going back and collecting taxes that might have been paid at 35 or 39% federal, and you can use this on your state income taxes as well. That's significant dollars that you may be able to offset to get a deduction on your taxes that where you pay taxes at 39% potentially, or even higher. That could be significant tax dollars. You just have to look at it. Everybody's situation is different. And all I'm just saying right now is talk to your accountants, talk to your tax advisors, and see if this could help you get dollars in your pocket now and do a little tax planning.
Good, thank you.
The CARES Act also changed this business loss limitation, which the TCJA limited business losses on your personal tax returns to $250,000 if you file single, or $500,000 if you file jointly. Sometimes that might have been limited. Well, the CARES Act has turned that off. It's saying you can deduct as much business losses that you have, and that is retroactive going back to 18, 19, and for the 2020 tax year. Could be again another big advantage that the CARES Act has initiated and changed the legislation. As of now, this limitation does not go back into effect. This limitation doesn't go into effect for 2021. So it's a limited opportunity for looking at 18, 19, and 2020. Also, the CARES Act also raised the business interest expense limitation, which again was a limitation of 30% based on the old tax law. Now they've raised it to 50%, and some of us may have some. This may affect some people. I'm not going to get too far into detail here, but again, they've raised the limitation from 30% up to 50% of your adjusted taxable income. There's a couple other items that increase liquidity for businesses. For single employer plans, you can delay some of your pension, profit sharing, and stock bonus plan contributions up till 1/1/21. A little bit of a delay because normally if you do an extension, you can delay it until September 15th. So you get a little bit of delay here, but only for single employer plans. And also the CARES Act made a technical correction for some qualified improvement property that was originally supposed to be for 15-year property, but when they did the TCJA, the original Trump Tax Act, they were supposed to make it 15 years, but they left it at 39 years when the legislation came out. Well, they fixed that technical correction, which means now for qualified improvement property, you're allowed to take bonus depreciation. Let's talk about how the tax code affected individuals. There's 4 items here that I want to talk about. We all know pretty much what's going on as far as this 2020 recovery rebate, this $1,200 per person rebate. Realize that this is an advance refund based on your AGIs for 2018 and 2019. It's going to really impact what's going to happen in 2020. It's just an advance for those employees with AGIs up to $75,000 for a single and $150,000 for a joint person. And then it's phased out when you get to $99,000 for a single and $198,000 for a joint. So it's really for your employees to get some money back into their pocket. Subsequently to enacting this in the CARES Act, it's a small amount relative, but it's going to help some people. They also changed the charitable contribution rules after the TCJA, where most people started to have a standard deduction as opposed to itemizing because of the limitation on the state income tax deduction to be limited to $10,000. Many more people were using the standard deduction. And charitable contributions started to fall. So what the CARES Act has allowed now is a small above-the-line deduction, not associated to your standard deduction, not associated with itemized deductions at all, but allows to deduct up to $300 of cash contributions that you made. And they also allowed you to contribute up to 100% and be able to deduct up to 100% of your charitable contributions if you so choose. The CARES Act also expanded your HSA allowability rules, which will cover telehealth services and non-prescription medical products. I guess, again, in line with what's going on due to COVID-19. Obviously, telehealth has become much more prevalent due to COVID-19 since everybody is at home. Now, there are a lot of opportunities as far as retirement plan impacts for individuals are concerned. Those of us who are taking our required minimum distributions, those retired people that started to take those, for 2020, it's suspended. You do not have to take your required minimum distribution. It gives some retirement portfolios additional time to recover from the market volatility that we've seen so far. And the volatility, certainly, if we look at it overall, and when the CARES Act really went into effect, the markets were down probably about 30%. Now they're down to probably between 15 and 20%. But there's really opportunities here as far as to look at your retirement portfolios, because there's opportunities here that we're going to talk about in a second. These suspended retirement, these suspended RMDs, these minimum distributions also are affected inherited IRAs that you might have gotten from parents that might have passed. You're collecting distributions from those IRAs. But if you're impacted by COVID-19, you can take distributions of up to $100,000 without any 10% penalty. So again, and now this revision is pretty broad. So the question is, who's really impacted by COVID-19? Well, we think pretty much almost everyone has been impacted by COVID-19. So any retirement distributions that you need to take could be an opportunity here to get some cash again into your pockets if need be. You can take those distributions up to $100,000, not be subject to the 10% penalty, which is a killer for most people. But you can also repay it if you so choose in up to 3 years. Now, of course, if you take money out of your retirement plan, that is subject to income tax. But if you plan to repay it, there's going to be the IRS is going to set up your tax returns in the future so that you will not have to pay the income tax if your plan is to repay that $100,000. But there's opportunities here, depending on what your situation is. And that is, if your income is lower this year, consider a Roth conversion. The Roth IRA is probably the best tax benefit tool for growing wealth in this country, because the Roth IRA is not subject to tax at all from the time you put the money in and let the money grow tax-free forever, potentially, until your beneficiaries need to start to take the distributions out. And what you're doing is you're taking advantage of the low tax rates now that you may have when we look at each of your situations. Some real opportunities here to consider some Roth conversions to take advantage of some of the lower tax brackets that are in effect now as opposed to in the future. Some employers can take advantage of this next rule, the student loan payment by employers. You can, employees can exclude 100% up to $5,250 of payments from their employees, from their employers, on if their employers use that funds to pay off their student loans. So what we're talking about here is as employers, you can go to employees and say, you know what, instead of me paying you wages of $5,250, I'm going to pay down your student loan. And what you will get as the employer, you'll get a deduction on paying making that payment of up to $5,250, and your employee doesn't have to pay any income tax on it. It is excluded from their income. So another opportunity here for a free deduction and really helping out your employees who may have some student loan obligations. A real big opportunity here to help those employees. Also note that the federal government has deferred all interest on federal student loans until September. Just a little something you can tell your friends, but to be aware of. So that's it as far as the tax side is concerned. Very willing to take all your questions. There's a lot here. There's a lot of moving pieces, and it is kind of confusing with this as far as the tax code is concerned, as well as what's going on as far as the PPP loan is concerned. People ask me,
Bob, do you anticipate changes to this content, or is it just hard to say?
No, I do expect changes that will be occurring over the next 2 to 3 months, depending on what's happening with COVID-19 and how quickly we recover. Again, the government is already talking about what the next stimulus is going to be. And everybody is holding off right now. We think, the Republicans think that we've done enough so far. Democrats think, well, we haven't gone far enough. So that battle is just starting to brew. And where that's going to go, anybody can say. And what's going to happen with COVID-19? This is definitely a moving target. We don't really know. And they're throwing so much at us as business owners, as citizens. It just, talk to people who are in the know. And there's a lot of good advice out there, and there's a lot of bad advice out there. But also guidelines that aren't even set.
Right.
And we're still trying to figure it out. And any question that you're asked right now, the answer is a best guess right now. I will say this, that there's some, that PPP loan money that we want to get forgiven. Right now, the question becomes, is that going to be taxable or not when it's forgiven? Right now, we're going to say, no, it's not going to be taxed. It's going to be tax-free money. But then what's going to happen with the money, the payroll that you made to your employees that you've used so that you can get that loan forgiveness?
Right.
Is that payroll going to be deducted or not? Is it going to be deductible, or is it going to be excluded and you're not going to be able to deduct it? Based on current tax law, that payment of payroll is not going to be able to be deducted on your tax return if you get loan forgiveness.
Mhm.
However, that's just based on current tax law. That's my best guess. Is the government going to change that? Is it going to have more guidance? Stay tuned. I
Yeah.
think it will be deductible when it comes down to it, but we don't know yet. And just stay tuned as far as there's a lot of changes that we'll go through, and we need to stay on top of this stuff.
Clearly. Let me throw out some questions to you. Did you say that if your company received the PPP loan, that all taxes have to be paid on time, or can company taxes be paid on July 15th?
So totally different things. Okay, what I think I was referring to was the employee retention credit. That is a totally separate area. But as far as your normal income taxes, the PPP loan has nothing to do with that July 15th deadline. That deadline is just for your 2019 normal income tax and corporate tax filings. And also as well as the 2020 estimated taxes. It has nothing to do with the PPP loan.
Okay. Is it correct that the stimulus checks will be deducted in future tax rebates?
Deducted, no. It could be a tax credit against future income, but normally what happened in 2006 when Bush had the $600 per person tax rebate. It ended up being reported on your 2017 or 2018 tax return. But if you got the rebate because you earned it based on the 2018 and 2019 filings, you're not going to have to pay it back. What that means, though, is in 2020, if your income is lower and you didn't get it because of your income was greater than the limits for the 17-18, was above 199,000. If it goes below that 199,000 in 2020, yes, you will get a credit on your tax return when you file your 2020 tax return.
Gotcha. There's a couple that I don't understand in the context, but one.
Yeah, this tax stuff is confusing.
Oh my goodness, it really is, and it's pretty dense stuff. I think I'm going to wait for the movie, but this goes back to, and you answered it before. You said it was a business decision. What if you perform work but can't pay your employees because you can't get paid for your customers? I mean, you got to make a decision there.
The best advice I can give you there is you got your PPP loan, hopefully, or your EIDL. And now you have your business relationship with that bank. And hopefully that process, that PPP loan through your bank went fairly smoothly. Well, you know what? You still got to talk to your banker. There may be still opportunities. You may need to take on some more debt. Yeah. And having that relationship with your banker is really, really, really important. Build that relationship. That's the best advice I can give you. Also, reach out.
You're running into a lot of smalls that, for better or for worse, these people are incredibly busy. They didn't have time to devote to developing those relationships, and now they're in the trick bag because they try and make their applications, and it's, if you're an existing customer, it's go to the head of the class. If you're a Johnny come lately, it's we'll get to you. And when we get to you, of course, the money ran out, and this next round should ease that. But it's challenge, to say the very least.
Yeah, and again, talk to your advisors. Your advisors may have pretty good relationship with some bankers as well to help you through that.
Right. we had
It's all
impacted.
about relationships right now in light of what's gone on, unfortunately or fortunately.
You know, we are not equipped to handle a large volume. Again, we do have the email set up, careact@impact-net.org. We have worked one-on-one with some of our contractors with good success in the PPP process. Thank goodness. Our job is to help our contractors remain viable during this pandemic. But reach out to us through the email or however you get in touch with us, and we'll hook you up with guys like Bob or other business experts. Here's another question. Is there a way that the 8-week PPP money can be extended even a few weeks?
And we'll see. I think potentially how long this COVID-19 situation for all of us, it may change. It may last longer. What's going to happen if you see that? I think there's going to be a second round of PPP money that may extend as well. So if you see that 8-week period extend, what I think is going to happen is the banks are going to, the government's going to say, hey, you know, you've got the PPP loans set up already. We're going to put more money into it, a second round for those people who've already gotten it, and to fund another 4 weeks or so, whatever it's going to be. The government wants to keep everything rolling, and if it means that we have to go into more debt, I think that the Treasury is going to allow that. I would not be surprised, and this is my opinion, I would not be surprised if there's going to be a second round of PPP loan money that's going to be kicked out.
I agree.
Just my opinion. But realize that 8-week period, let me just say one more thing, Kevin. That 8-week period starts when you get funded.
Okay.
So keep track of that. So during that 8-week period, if you want to get that loan forgiveness and you're using that money for 75% for payroll and 25% for rent, interest payments, and utilities, and you want to get that loan forgiveness, that 8-week period starts when you get funded.
Okay.
Keep track of that.
Is it possible, are you willing to share these slides?
Sure.
Okay.
Not a problem.
And again,
I know there's a lot of data there, so.
Yeah, of course, this is recorded and will be up on the Impact website later on tonight. Let me ask another question here. If you can discuss the personal stimulus. My stimulus check was labeled, quote, PPD, IRS, Treasury, 310, tax ref, end of quote. Can you please describe how this will be treated on our 2020 returns?
Not taxable.
Okay, good.
Okay. The IRS may say they want to make sure that they may report that you got the money. You may have to report it on your return, but it's not going to be taxable. We think that is going to be not have any effect to 2020 at all, but it's definitely tax-free money. It is a rebate of federal income taxes that you paid previously.
And will you be discussing the documentation that businesses should track and keep for the 8-week period of the PPP? So what's the documentation they need basically to prove this?
Yeah, that's a great question. And from what I've read about the PPP and the loan forgiveness, that's going to go through each bank that you got the money from. So you'll go back and they'll look, and I think what they're going to do is you're going to look through that 8-week period and say, okay, show us what you paid. All right, here's your payroll. Here's the rent that you paid. Here's the checks that you wrote. Give it to your bank, and they will determine whether you're eligible for that loan forgiveness or not. Now, I will say this, there's not a lot of guidance, except for what I just told you, from the government right now. But that is all I've read. That's all I've seen. each bank is going to do it differently. It's kind of just realize, it's we don't know. We don't know yet.
Okay.
Just like the PPP loan, when it went into effect, each bank did it differently. Each bank had their own situation, their own problems. I'm sure it's going to be the same way as far as the loan forgiveness is concerned. But be prepared. But just as a general rule, keep track of that 8-week period. Keep track of your document where your payroll has gone, and your payroll company will be able to do that. And keep track of your checks that you paid during that 8-week period.
Okay.
Your account becomes real important now.
And keep in mind that in the future, we'll likely be conducting a webcast that just talks about managing your PPP reporting and loan forgiveness. As you can tell, this is all brand spanking new within the last 30 days. So there's going to be a lot of guidance from our subject matter experts. The other piece is within the PPP loan, can lease payments on equipment be part of the 25% that applies to rent, utilities, et cetera?
That's a great question. I'm not really sure. Off the top of my head, I'd say no, but I'll research that very quickly. I do know that your normal rent and normal mortgage interest payments are eligible, as well as utility payments. So based on that general statement, I would say no as far as lease payments related to equipment is concerned.
Okay. The question, will benefits be figured into the 75% wages? Yes, absolutely. We've run through that already. Yes, we know that an impact to be a fact.
Yes, and I agree with that. Now, when you say benefits, though, okay, that will not include payroll taxes.
Right.
Payroll taxes will not include in that number.
Gotcha. Can you use PPP? Hold on, I just skipped on me. Can you use PPP loan towards the principal of a loan? Can you pay another loan off with your PPP?
No.
For payroll? And
just payroll and interest on mortgages and rent and utilities.
Union benefits would be eligible because it's part of compensation, no?
Union benefits I would think that's part of the benefit number.
Yeah, absolutely.
Right?
Yes. Yeah. So the answer is yes.
Mm-hmm.
Let me see, make sure I didn't skip any in here, Bob. We've covered a lot of territory. Slideshow, 8 weeks. We got that.
Keep them coming.
Here's a good one. Being declared a disaster area in Washington State / Seattle area, does this mean that additional help may be available to us that is not available in other places? If so, what are the things that could help an erector, steel erector, fabricator who is in a declared disaster area?
Well, the whole country is a declared disaster area. So again, it goes back to the IRS postponements, the things I talked about at the beginning of this webinar. I would say look at your state websites, look at COVID-19, look at your county websites, look for particular benefits and legislation that each local area has. And
there are assistant programs down to the county level that would be published out on your county's website. Certainly state, in some cases municipal level.
Yeah, you bet.
Here's another question, Bob. Is there any discussion at the congressional level regarding helping healthcare plans provide extensions to families losing coverage during the COVID-19 or due to the COVID-19 pandemic?
It's a great suggestion. I would say that. Nothing Nothing so far, but I am sure at the next round of congressional legislation may include something like that. I think it's a great idea.
Okay. And with that, sir, let me just scroll through one more time. On the PPP loan, are you saying union benefits are part of the payroll calculation? The answer is yes.
As part of the benefit
Absolutely.
calculation, yes.
Yeah.
Yes, and it's part of that 75%. Again, 75% of those proceeds from the PPP loans need to be used for payroll and or benefits, and 25% maximum can be used for mortgage interest, rent, and or utilities. So there's that where that limit is, that 25%.
Yeah. Good. Well, with that, sir, we really appreciate your time. My boss is the general president of the Iron Workers, Eric Dean, his partner co-chair, Bill Brown of Penn Services. Really appreciate this, and the entire Impact Board, both iron worker and contractor. We'll stay in close touch. We'll funnel you any other questions. And again, thank you very much for being on with us today.
You're very welcome. Just again, there's a lot of opportunities out there to really conquer this thing. Again, I would talk to your advisors, talk to Kevin, and good luck. And everybody, please stay safe, stay healthy.
All right. Thank you, Bob. Have a good one.